Hi, I'm Fernando Sabeta from Brazil, Sales and Technical Service Manager for South America.
And I am Cesar Melendez, Sales Director and Technical Service for Mexico.
We are going to talk about the first quarter review of global economy and mention some graphite electrode industry. According to World Bank prospects, first quarter shows a soft of growth prospects, rise of inflation expectations, concerns about the near-term outlook, and lower risk appetite. Developed economies such as US experienced volatile activity indicators induced by heightened uncertainty. China experienced a slowdown in trade. Despite of the mentioned, Purchase Managing Index surveys generally indicate a continued resilient activity in emerging markets and developing economies.
The growth and inflation concerns amid heightened uncertainty. This is creating some slowing demand and rising input prices. Some businesses began to reduce employment, and momentarily global manufacturing PMI accelerated partly due to anticipation of the new tariffs. A slowdown of the two major engines of the global economy, which is United States and China, anticipated to be counterbalanced, strengthening growth in other regions.
According to the World Bank highlights, the Brent crude oil price were volatile in early March. It was around $60 BBL. Ongoing trade tensions, rising OPEC plus production, and increased U.S. crude inventories. The European natural gas price gained 5% in February due to cold weather and low inventories. Metal price climbed 3% in late March, led by tin 7%, copper 4%, aluminum 3%. About the economies, growth is projected to moderate in East Asia and Pacific. Weak domestic demand in China and as well as in Europe and Central Asia, owing to deceleration in some large economies. In contrast, a pickup is anticipated in Latin America and the Caribbean, Middle East, and North Africa, partly underpinned by robust domestic demand. Risk throughout the outlook remain tilted to the downside across our regions, centering on diverse shifts in global trade and other economic policies. The possibility of escalation conflict is lower than expected growth in China and the United States higher than expected inflation, and attendant slower monetary policy easing pose further downside risks.
On East Asia and Pacific, the growth in this region is projected to slow about 4.6% in 2025 and 4.1% in 2026, reflecting a further deceleration in China. In China, growth is expected to decline from 4.9% in 2024 to 4.5% in 2025 and 4% in 2026, amid broad-based weakness in domestic demand. Elsewhere in the region, growth is projected to edge up to 4.9% in 2025 before settling at 4.7% in 2026, anchored by solid domestic demand. Risk to the outlook remain titled to the downside and center on adverse global policy shifts, particularly relating to trade policies and a sharper slowdown in China. Further downside risk include spillovers from an anticipation of conflict notably in the Middle East, and climate change-related natural disasters. Middle East and North Africa. Growth in this region and North Africa is expected to pick up from estimated 1.8% in 24 to 3.4% in 25 and 4.1 in 26. The outlook for this year has deteriorated due to the extended oil production cuts by major oil producers. The major downside risk to the outlook are the intensification of armed conflict in the region, heightened policy uncertainty, and unexpected adverse global policy shifts. Delays in oil production could also slow regional growth. Other downside risks include persistent global inflation and resulting tightening of global financial conditions, heightened domestic violence and social tension, and more frequent extreme weather events.
In Latin America, the growth in Latin America and the Caribbean is forecast to increase from 2.2% last year to an average of 2.5 in 25-26. This improvement is partially driven by Argentina's expected recovery following 2 consecutive years of contraction. Most central banks in Latin America anticipate to resume interest rate cuts in 2025, after pausing in the second half of 2024, due to the new price pressure. A tightening of global financial conditions would raise debt servicing costs. In South Asia, the growth is expected to remain high over the forecast period, average 6.2% in 2005-6, with a high level driven by the resilient activity in India. Aggregate growth in the rest of the region is also projected to firm to 4.2%. With activity pickup in many countries, major downside risks included heightened policy uncertainty and a diverse trade policy shifts in major trading partners, as well as higher commodity price.
Sub-Saharan Africa. Growth in Sub-Saharan Africa is projected to stand to an average of 4.2 in 2025-26, driven primarily by improvement in the outlook for industrial commodity exporting countries, including the region's largest economies. However, high government debt and elevated interest rates have narrowed fiscal space, prompting fiscal consolidation efforts in many countries, while financing needs remain high. Downside risks include weaker global growth due to heightened uncertainty and the potential for adverse changes in trade policy, a sharper than expected slowdown in China, increased regional of global instability, such as an escalation of conflicts in Sudan and in the Middle East, which could drive up energy and food price inflation in the region. Increased risk of government distress amid a possibility of higher for longer global interest rates. The price oil, the Brent crude price oil, estimate to trade at $70 in 12 months.
About the iron ore price, 62% iron content, estimated to trade at $92 in 12 months' time. The steam coal price in futures fell to below $97 per ton in April, over 20% down year to date to the lowest in nearly 4 years. Data from Indonesia showed that output hit a record of 836 million tons last year, exceeding its initial target by 18%, even though growing investments in alternative power source kept the demand for feedstock in thermal coal plants. Additionally, China plans to boost output by 1.5% to 44.82 billion tons this year. According to London Metal Exchange, steel scrap from Turkey reached a value around $100 per ton.
According to the London Metal Exchange market, the hot rolled coil steel free on board China, the demand for Chinese is expected to weak both at home and abroad. Limited supply willingness may help prevent sharp price decline. Nickel is estimated to trade at $13,900 in the next 12-month time. Aluminum decreased 149, almost $150 per ton, or 5.9% since the beginning of 2025, according to a trading on a contact for difference that tracks the benchmark market for this commodity. Aluminum is expected to trade at $2,360 per ton by the end of this quarter. According to the Trade Economics Global Macro models and analyst expectations. Looking forward, we estimate it to trade at 2,240 in the next 12-month time. Finally, copper is estimated to trade it at $8,500 in the next 12-month time. India medium carbon silicon manganese escalation in prices in Q1 2025 stands for a widespread increase in production expenses and operational overheads.
Now, according to World Shipping Index, the Freight Baltic Index Global, CMCGM identifies new ship deliveries, potential Suez Canal reopening, and the U.S. tariffs impact as key factors shaping the container shipping sector in 2025. In the last months, we have an average price around $3,000 for global 40-inch container rates. Other freight implications of Trump's tariffs. The anticipation of new Trump tariffs has driven many U.S. importers to front-load as much inventory as possible since November. This pull forward of demand was one factor that has kept U.S. ocean import container volumes stronger than usual since late last year. Many importers who've built up inventory are likely to be able to reduce or pause orders and shipment until the tariff dust settles. This move will see container volumes and rates drop, possibly significantly soon, and could be one factor that will cause a very subdued peak season period this year, similar to how a tariff-driven pull forward in 2018. Once inventories run down, the strength of the container market will depend on the economic impacts of the trade war. Lower consumer demand will lower demand for freight. And with none of the U.S. major sourcing partners spared from significant tariffs this time, containers that do move will come at higher tariffs costs to shipper and the other customers.
Global steel crude production, January and February 2025. World steel production for the same 69 countries reporting to the World Steel Association was 145 million tons in February 2025, which means a 3.4 decrease compared to February 24. China steel production reduced in February 2025 by 3.3%. Except for India, almost all of the top 10 producers expected experience a reduction. Steel rebar in China were near 3,050 yen per ton in April, over 7% down year to date, as the escalating trade war between China and the US pressured the outlook on construction and manufacturing to the world's top ferrous metal consumer. China raised levies against the US to 125% and warned that it will dismiss further retaliation to US goods are no longer marketable in China. Even though most of the US tariffs exclude steel, and steel trade between the two countries is a small fraction of the global flow. Concern over both economies pressure the outlook on ferrous metal buying at the world's top consumer. Still, the impact of tariffs on China steel was lower than those in base metals, as expectation of aggressive economic stimulus from Beijing is set to support household consumption and properly developers' financial health. Also, Beijing signaled it will be mandate capacity cuts for steel mills as a reaction to protectionism trade from Vietnam, South Korea, and Brazil.
Let's talk about some graphite electrode outlook. In the China domestic market, the coke price dropped from $1,300 per ton following the oil needle coke, and nowadays is around $1,200 per ton. Okay. Low sulfur petroleum coke sector price increase and the scarcity due to sudden demand from the aluminum industry in China that forced momentarily to use low sulfur pet coke due to shortage in import of medium sulfur pet coke. This had a contribution to an increase in the overall cost of graphite electrodes. On the demand side, the rate remained unchanged. Needle coke spread over low sulfur anode was momentarily reduced or even negative. Second quarter likely to stabilize the price of both coke used in production of small and standard size graphite electrodes. Graphite electrodes under 500 millimeters or 20 inch diameters have seen spot price climb from recent lows, as environment curbs and scarcity and high price of low sulfur anode coke forced select producers to scale back or suspend small diameter graphite electrodes output, tightening availability in the first half of 2025. As a conclusion, uncertainty regarding the US President Donald Trump tariffs plans, which could impact global commodity trade in the middle term. Chinese steel export reached a record of 110 million tons in 2024, a 23% increase year on year, raising concerns about global oversupply and challenging regulators to balance domestic priorities with international trade rules. Another surge in New Year related shipment has pushed ex-Asia containers rates to a higher baseline, driven in part by Red Sea diversions. and North American imports are front-loading orders ahead of expecting 2025 tariffs hikes. Low sulfur anode coke momentarily scarcity led graphite electrodes under 500 millimeters diameters spot price to climb from recent lows. And that's it, my friends. Thank you.
Thanks for being with us.